Today, CDAR is delighted to welcome Agostino Capponi from Columbia University, an old friend and colleague of mine. Thank you for joining us today, Agostino. And the topic is robo-advising, personalization, and goals-based investing. So please take it away.
Perfect. Thank you so much, Lisa. Let me go ahead and share the slides. That's the first thing. Let me see if anybody can see the slides. Good. Okay, so let me first of all thank Lisa for inviting me to present. Of course, it's always a pleasure to present virtually. And I remember, Lisa, we had the first interaction about 10 years ago for a book on counterparty risk, and I think we have known each other for a few years. And recently we met before the pandemic, as we were mentioning before, at the SIAM conference in financial mathematics and engineering, where I was presenting some work related to robo-advising. So this is an evolution of that work that I had presented, and this is a topic that I've been working on in the last few years, along with others. And it's about effectively about optimal investment. And here I want to present two different approaches. One is based on classical mean variance portfolio selection problem, where we try to learn to take into account that the algorithm, the robo-advisor, may not know what are the client preferences. And the other is more about goals-based investing, which is a very different approach to automated investment. Okay, like robo-advising, just a few words about what this is. This is essentially algorithmic-driven investment. The objective is to design an algorithm which is able to perform investment on behalf of a client. What the algorithm has to do, he has to adapt to the risk preferences and characteristics of the client. Typically, there is very little which is known about the client by the algorithm because it's managing many clients simultaneously. So what it has to do is to make sure that over time, the attitudes of the client are learned, and as a result, an optimal investment strategy can be designed. They do automatic execution, automatic rebalancing. So they take care of all the services on behalf of the client. And one of the benefits of robo-advising is to democratize personal or financial advice. And the reason is that, as I will show later, it removes barrier to entries. A couple of firms that started in this business as startups around the time of the financial crisis are Betterment and Wealthfront. They both provide robo-advising services. Since they were first started, there have been a lot of incumbents like banks, which have also set up robo-advising desks to provide investment advice. It doesn't have to be necessarily investment in terms of managing or optimizing portfolios, but robo-advising is a broad term which also includes other services such as decides on tax loss harvesting, for example, understanding when it's better to liquidate an asset in order to harvest the loss with the objective of making sure that the tax benefits that you get are large enough. So selling at a loss and maybe repurchasing the same asset at a slightly higher price. And at present, they are both becoming a day-to-day manager in the sense that they have access to your checking or saving account, and they perform financial services, which are not necessarily planning for retirement, but also, for example, planning to meet financial goals, including buying houses or paying for children's education, etc. Whereas the old style or the first robo-advisors were mostly long-term money managers, effectively planning for retirement.
So, Agostino, I've got a question for you right away. Have you used Betterment or Wealthfront?
Yeah, I used not to make investment, but mostly to understand how they do their investment. So they ask you questions when you are profiled for the first time, and I've used the interface, the web interface. Betterment is using more like a goal-based approach. They want to manage your investment to meet goals.
Yeah, I'd love to chat about that. I've done it too. Okay, so it'd be interesting to compare notes, but please go on.
Absolutely. I have the second part of the talk, which is a bit inspired by what Betterment does. So I'll be happy to go to discuss more about that, Lisa. Let me go again. What robo-advisors do, they differ in terms of what strategy they use for their investment. For example, if we look at Wealthfront and Betterment, they are two robo-advising firms. They use different type of approach to investment. Wealthfront is more, I would say, a traditional investment platform, which is basically investing based on the mean variance portfolio optimization framework. The objective is to maximize the portfolio, inputting typically some views of the client, so like a black Litterman type of model, and also incorporating constraints that investors may have. And of course, managing the fact that the risk preference of these investors are not known, right? You don't know what is the optimal trade-off between mean and variance. Betterment instead a very different approach, and this is the approach that we'll discuss in the second half of this talk, which really removes any utility function from the investment problem. So you don't have to maximize an expected utility, but rather they will manage the portfolio to meet goals. So there are goals that the investors specify. These goals span a period of time, and the objective is to invest in such a way that when the goal deadline comes, there is enough wealth to meet that goal. Okay, it's definitely an industry which is worth, one should look at seriously, because I mean, although it started managing a few million assets in 2017, we have, sorry, in 2008 it was even lower when there was a time of the financial crisis. But this is basically an historical histogram which looks at the evolution in terms of asset under management of robo-advisors, and what we see is that there has been a steady increase. So, right, I mean, last time we checked, because 2021, they were managing about 1.5 trillion in the United States, and what you see 2022, 2023, and so on, these are the projections of how many assets they will manage. Like, and you could see that as the assets under management are increasing, they are still a small portion of the total assets under management, but it's growing. Okay, what are the benefits of robo-advising? As I mentioned before, they have very low entry barriers. There is a lot of financial inclusions. In fact, if you want to invest using a robo-advisor, you need a very low fees to enter. Typically, they ask you a fee which is around 0.2% or even lower than that, in comparison to the traditional financial advisor, where you need to pay a 1% fee or even larger. So that means that you have a significant benefit in terms of the fees for the asset under management. And in addition, you don't need to have a large amount of wealth to go to a robo-advisor. In fact, some robo-advisors have even investment minimum which are around zero. So you basically, even if you give $50 or $100, they will still do the investment for you. Whereas if you want to go to a traditional financial advisor, typically you need to have around $100,000. Otherwise, they will not do an investment for you. What they do is also they provide unbiased financial advice. Of course, this has not been tested under all possible circumstances. There are always questions about whether or not the financial advice is fair, because this is related to the question about fairness of algorithms, because an algorithm, of course, makes decisions automatically, but it also depends on what code is being used to provide this advice. They are, of course, very sophisticated because they are all algorithmically executed, and they do a lot of different services, including rebalancing your portfolios, deciding how much to load in each specific asset, and also they do a lot of tax loss harvesting. That's another topic which has not been studied extensively, but it's very important because it's a large part of the robo-advising business is to actually managing the portfolio or optimizing the portfolio, taking into account that you want to optimize the taxes. And this is a very difficult problem because it's very non-Markovian. There is a lot of, the amount of tax that you have to pay typically depends on the entire history of trades. And what are the cons of robo-advising? Okay, the cons are, there are a few papers, primarily empirical papers, that have been written on this topic, which basically argue that there is the so-called lack of human touch, meaning many clients, especially those who are, especially I would say more on the older side rather than the younger side, are a little bit worried about the fact that their advice is being given by an algorithm. So if things do not go well, they don't have anybody to complain or anybody to talk to. In a way, the human advisors provide this so-called peace of mind status, like saying that the fact that even if things go badly, and maybe they don't go badly because the investment strategy is not good, just because the market outcome is not favorable, then you can still talk to a human advisor who can explain or who can try to explain the situation to the client. But if the decision is made by an algorithm, that's hard. That's something more difficult to do. There is very limited customization, meaning at the moment, there is very little way of personalizing the investment. And this is one of the first topic that we're studying, like in the first part of the talk. I will discuss how you can personalize better the investment in terms of understanding what are the risk preferences of the client. And another, of course, con is that there has not been enough data to test under different circumstances how the robo-advising algorithm would work. Okay. Right. Now this shows that this slide is showing that there is a very large business in robo-advising, and the part related to portfolio investment is only a small part. So portfolio management is one of the uses of robo-advising, but they provide a lot of more services, including planning for retirement, micro-investing, digital brokerage services. They do business to consumer services, etc. So it's really a very large business. Okay, now I want to go more into the modeling part and the technical part of the presentation. The first type of approach that I want to propose is modeling human advisor in what we define as a human-machine system, where really this human-machine terminology is inherited from the machine learning literature. Here, what I mean is really that the machine, which is the algorithm which will do the investment, will try to learn what are the preferences of the investor, who is a human. And based on this interaction, they will refine the investment strategy. Okay, so as I mentioned, these preferences are dynamic. Here, dynamic means that they are time varying. They change over time, and they change based on several characteristics, depending both on the market outcomes, but also on idiosyncratic change in preferences of the investor. And also there is a repeated interaction between the client and the robo-advisor. So it's not a one-shot interaction. They don't interact only at the moment where the client is profiled, but they also interact throughout the time of the investment, where the client is trying to signal or to communicate information to the robo-advisor, which will then execute the investment strategy. And here we aim at capturing two important characteristics that have been highlighted by empirical literature. First is personalization of the portfolio, so offering to the client a portfolio which reflects as much as possible its risk needs, so its risk preferences. So for a very risk-averse investor, we want to offer a portfolio which is not loading too much on the risky asset. For a less risk-averse investor, we want to offer a portfolio which is loaded more on the risky assets. And also, we would like to see whether or not there is any client involvement needed. So we want the client involvement to be there, but we don't want to have a very heavy involvement of the client. Otherwise, the client will say, okay, why do I have to go to a robo-advising firm? I can invest the money on my own, of course, if they have the right expertise to do so. Okay, what type of information is communicated by the client to the robo-advisor? Meaning the client, what the robo-advisor would not know without communicating with the client is idiosyncratic information. For example, life events of the client, if the client has a change in his professional status or a change in his family, for example, the birth of a child or like any important event happening, then this information is of course not known to the robo-advisor unless the client communicates it. So this can be implemented, or typically is implemented through like periodic forms that are sent either via email or via phone by the robo-advising firm to the client. And this is a way to acquire this information. So this input is then processed by the robo-advisor, who would translate this into the so-called utility function. So in this presentation, in this paper, in general, we are abstracting away from the mapping. So how do you map input provided by the client into a risk preference function or a risk and utility function that needs to be maximized? Of course, this is also another important step, and it requires a lot of attention to understand well, to basically try to encode the information coming from the client into a mathematical model reflecting the client's utility. Then the robo-advisor, after he has translated this information into a client utility function, is solving an optimal portfolio problem and make a recommendation about what investment strategy should be used. And now, depending on the robo-advisor, the client may or may not have the option of overriding the recommendations of the robo-advisor. So the idea is basically, suppose that the robo-advisor makes a suggestion to the client, and the client say, no, this is too risky, I would like to take a safer strategy, the client may have the option of going against the robo-advisor wishes. So instead of catering to the robo-advisor decisions, the client is going against that. And this first work is based on a paper that we have written with Talia Zaripopoulos and Svein Olafsson, who was a postdoc here a few years ago. And what we did is basically we developed a communication strategy between the client and the robo-advisor, and we modeled this communication, as I mentioned before, in terms of a human, what we call a human-machine interaction system. Basic idea is that this robo-advisor is solving an optimization problem, and this is going to be a discrete time invariance optimization problem. So it's like a classical mean variance Markowitz model, which most of us have seen as a one-shot optimization problem. So you maximize this trade-off between mean and variance at specific time. So here we want to do that dynamically over time. And we also want this problem to be adaptive. And adaptive here means that it adapts to the change in utility functions of the client. So in a way, we take into consideration a parametric utility function. So the mean variance model, we are already making very strong assumption about what is the utility function which is being used, but we don't know exactly the final form of this utility, because in order to pin down exactly what mean variance utility function we have, we need to know what is the risk reward trade-off coefficient. What is this parameter which trades off the importance of the mean versus the importance of the variance? And this is exactly what has to be learned from the robo-advisor. So one slide about what technically what one needs to do. He has to solve essentially an investment problem where the preferences of the client are dynamic, they are changing over time, and they're also stochastic because they are subject to idiosyncratic shocks or to market shocks. So there is like this risk preference parameter is indeed a stochastic process. You don't know what will be the utility function of the client. And the risk optimization problem is what we call an adaptive control problem. But there is a lot of literature in control, which looks at adaptive control from a different point of view. Like you assume that you have a specific criterion, optimality criteria that you want to maximize. But what happens is that the system that you are controlling is not always preserving the same dynamics, in the sense that there might be changes to the dynamics of the system, changing the parameter which are governing the dynamics of the system, which needs to be incorporated in order to make the optimal decision. Here, the dynamics of the system, which are essentially the dynamics of the market, which specify, like, for example, the geometric Brownian motion, which is driving the asset prices, is given. So there is no change in the dynamics, or at least any change is already encoded into the dynamics that you specify. But the utility function is what is changing. So that's really the difference. It's adaptive in the sense that you have to adapt to the utility of the client, but you don't have to adapt to the dynamics of the system. The dynamics of the system are known at the very beginning. Of course, a different interesting extension of this framework would be what happens if you also need to adapt to the dynamics of the system, because you make an assumption that you know the dynamics of the market prices, but of course, this may be revised later because you realize that what you had assumed based on the information that you got is not really what you should be using from now on. Okay, so but that's not one step at a time. We decided to focus first on the most important criteria, which is understanding how the risk preferences change. And here, as I mentioned, we focus really on the family of mean variance optimization functions, where, as we know, we have the mean variance trade-off parameter, which is just a single parameter, and the client will have a different risk preference parameter than the robo-advisor. So let me clarify what I mean. I mean that the risk preference of the risk aversion process, which reflects how risk tolerant the client is a stochastic process, which is known, of course, to the client. So the client knows at all times what is this risk aversion. But the robo-advisor may not know this information. So what the robo-advisor does is creates a model of the client risk aversion, which we have denoted by gamma R. So gamma R is what the robo-advisor thinks that the client risk aversion is, whereas gamma C is what the client risk aversion really is. And these two processes are different for two important reasons. So the main source of difference is the fact that the communication between the human and or the investor or the client and the algorithm is imperfect. The first is that the demographics of the client, which reflect this change in idiosyncratic risk preferences, are only revealed to the robo-advisor at the times where they interact. So if, for example, they're interacting every 5 time units, suppose that each time unit is 1 week, if they're interacting every month, then of course, after they interacted, there will be 4 weeks where the robo-advisor does not know whether or not there has been a significant change to the client's demographics. But even if, let's say, they would communicate at all times, suppose that we allow for communications to be like done at all times, there will still be a difference between the intrinsic preference of the client and what the robo-advisor perceives the client's preference to be, simply because the client may communicate information which is affected by behavioral bias. For example, if there has been a positive market event, or if like the market has been trending upward, then the client might reveal that he is less risk averse than what he really is. And the robo-advisor will basically not be able to discriminate, to disentangle this bias effect from what the client is communicating to him. So that means that there is a second source of difference is due to the fact that information is really biased and it's affected by the market outcomes. So the client is not able to communicate what his real preference is. He might be overly enthusiastic or he might be overly pessimistic just based on what happened to the market. And then we want to design an optimal investment strategy. I think Lisa, are you asking a question or?
Yes,
Okay.
now I'm asking the
You're
question
muted.
by voice.
Yeah.
Thank you. So this is like super interesting. So of course, we can even take the current situation as an example. There's been a lot of turbulence and downturn.
Yeah.
And clients I'm just trying to get at the word real that you use, what the client really feels, because to my experience, the clients really feel that they want to get out of the market right away. Yeah. So that they don't lose another penny because it's been painful. And we might say as investment professionals, well, it's bad advice, when you're skiing on ice, hang in there, or not, different professionals. But even though it may be poor judgment on their part to downsize, say, their stake or whatever they're communicating, it is the job of the algorithm to calm them down, or is it what do you mean by real? That's
right. Okay, that's a great question. So first, let me answer your question. Exactly. In the periods where the client feels like I want to exit the market because things are going badly, that's also the period where the Sharpe ratio that you can earn is larger, right? Because you would get much more reward for the same unit of risk simply because the Sharpe ratio is countercyclical. When the economy is doing poorly, typically that's the time where you should be invested. And this is the job of the robo-advisor. Advise the client that, look, don't panic, don't exit the market, because these are exactly the times where you can make more profits from staying invested in the risky assets. So that's the job of the robo-advisor. Now, in terms of, and this, I think, in the paper, we have an experiment where we show the difference between what the robo-advisor would do and what the client would do if he was unadvised. And then we can see what's the distribution of return. You see exactly that the distribution of on the return, the return that the investor would get if he was listening to the robo-advisor is always like dominating the distribution of returns that he would get if he were investing on his own, which means just deposit everything in the risk-free asset when things are going badly. So that's really one of the main uses of the robo-advising. So you hit on the right point. But here I want to clarify what I mean by intrinsic risk aversion. I mean, what is the fundamental risk aversion of the client? So what is really what does the client really think if he was not hit by overly market outcomes, which might just push him to reveal that he's more or less risk averse than what he really is, just because he's affected by these behavioral biases. So if you could debias the client from all the behavioral biases that he gets from momentum or other like market outcomes, what would be the real preference of the client? That's what I mean by intrinsic risk aversion, like his fundamental risk aversion.
So
Of course,
you're imagining some calm underlying process that's certainly distorted by what happens in the world, and you're trying to take that distortion out.
exactly. Yeah, exactly. So you want
Okay.
to take this discussion out. The question is that this might be difficult to do, or I mean, and it is, in fact, estimating the intrinsic risk aversion is a difficult process, is a difficult task, but that's what I mean.
Got it. Thank you.
So now here is a very simple strategy. I want to describe a very simple way of communicating, which is the following. In general, there are many different strategies you can follow. For example, there might be a communication between the client and the robo-advisor happening every, say, month. So in this case, for example, it happens at time 5, then it can happen again at time 8, etc. I mean, you could decide to communicate at deterministic times, which are decided beforehand, or you could decide to communicate only when significant market events happen. For example, if nothing is happening, if there is nothing really significant, then you might not query the investor. But if you see that there has been a significant market event, then you might want to ask the client, okay, has something changed in your status based on the events in the market? And can you tell me what your preference is? So in general, you can make the triggering times which signal like when there is a communication completely stochastic. In this case, I mean, again, because this was the first study that we tried to do, we assumed that the communication is happening at deterministic times. But of course, if one wants to generalize the framework and introduce communication times, which are like depending on the market events, this could be done. So let me now specify what are the dynamics in the market. I mean, we have just a representative risky asset. We can think about like a stock index. You invest in the risky asset, or you can invest in the risk-free asset. So just two assets. We are working with the discrete time model. So we are modeling the dynamic of the asset as a discretized geometric variant motion. And more precisely, this is modulated using a Markov regime switching model. So the idea is that we have the return, the price of the asset at time n plus 1 is equal to the price of the asset time n times 1 plus this market outcome z, which is essentially the return. But this depends on the current state of the economy, which we are modeling by y. So y is essentially modeling, okay, what's the state of the economy? It could be an expansion state, it could be a recession state. So if you're in an expansion state, then the return will be higher and the volatility of the return might be also higher. But if you're in a recession regime, then the expected return might be lower, and also the volatility of the expected return might be lower or higher, right? In general, you are just specifying different values for the mean and variance of the returns depending on what is the real state of the economy. And in this specific case, the state of the economy is modeled using a Markov chain. So the economy stays typically in the same state for a long time, and then it switches to a new state. And we are assuming that these Markov states of the economy are observable. So at time n, you know exactly in what state the economy is. If y was not observable, it was a hidden Markov regime switching model. Of course, this would have introduced other complications. But this is not really the point of like using, we're not really trying to estimate the hidden regime here. We're assuming that the economy is driven by the dynamic are modulated by these regimes. And in order to understand also the model, as I mentioned before, we have that the Z is the risky realization, and there is a return. The mean of Z is equal to mu, and the variance is equal to sigma square, and they both depend on Y, which is the state of the economy. And the filtration, which is the sequence of the historical sequence of market information that we get, or any random sequence of events that happened, is really a signal algebra generated by the history of economic regimes, which is yn. So this parenthesis n denotes the history of regimes that we have observed until time n. Z is the history of returns that have been realized from 1 to n. And then there is this other quantity epsilon, bar epsilon, which denotes the idiosyncratic changes in client preferences from time 1 to time n. So this is real information which comes from the client. This information that only the client knows, and the robo-advisor does not, unless there is a communication. Okay, so
Hey,
that's, yeah.
yeah, Agostino, I got another question about this mu up here in bullet point 3.
Yeah.
So this is some unconditional mean, because aren't the state dependent means, like there must be,
Yeah.
the state dependent means, at least one of them must be below R. Like
Yeah.
the bad regime, because it's negative, like
Yeah.
the 2008 regime.
Yeah, absolutely. This is like, sorry, right. Yeah, you're right. So this is, yeah, in this paper, essentially, we're assuming that the both regimes, both returns under both regimes is always larger than the corresponding rate in that regime. But you're right that, I mean, it's an assumption that basically we need in order to make sure that you are always prefer. I mean, if you would, I think it's a good question. I think even if you would have that mu y would be larger than ROY in the expansion regime, but would be lower than ROY in the recession regime, the analysis would go through. And this is a good question. I think in the paper we made this assumption, but I will have to verify if it holds. But it's a very good point. Yeah.
Also, I mean, I've fit these things. Of course, it was like centuries ago, but it's kind of beautiful how it comes out, because it breaks down pretty nicely into two regimes, and one has got a nice positive mean and a low volatility.
Yeah.
And one has a terrible mean and huge volatility. And also, if you split your if you split your observations into two, all the skewness and kurtosis goes into the bad regime too. Even if you start with a normal Hamilton model, which is what everyone does, the fit isn't very good normality wise in the bad regime, but some of what you see is quite intuitive. So anyways, I'll let you go on, but
no, I think it's a great point. Essentially, calibrating these Markov regimes models is typically difficult. In fact, I think what you are mentioning is typically boiled down to calibrating two regimes, because going beyond two is difficult.
So, some fancy people try to do more. I have trouble keeping track of them, but the two regime one worked out surprisingly well, in the sense that I could see some stuff really intuitive and then also see some obvious flaws. But no, this is great though.
No,
this is a great framework.
Right. Now here we are essentially, I mean, I think that the hard part is indeed to calibrate this model. You are assuming that, okay, these parameters are given, but of course, if one wants to use the model, these have to be estimated. Following more the probabilistic instead of the statistician approach, where you carry a lot about estimating the parameters. Right. So now let me mention about the interaction schedule. As I mentioned, this is this decay are the times when there is interaction between the robo-advisors and the algorithm, and assuming that this is an increasing sequence of stopping times. I mean, the most general version of the model, we do not really need to assume that interaction schedule is deterministic, but it's essentially you can decide when to interact based on all what is observed, based on the information that the client has about his risk preferences, and based on the realization of the market and of the economy as a whole through the regime switching model. And right, and then I'm defining this tau n to keep track of what is the last time that there was a communication prior to n between the algorithm and the investor. So essentially, this is defined as the soup over tk, such that tk is more or equal than n, meaning if the last communication time before today was last week, then tau n will be exactly last week, because that's the last time that we had a communication since, I mean, including all times until today. And this is important because we know exactly what information the client has revealed to the client, to the machine, exactly at the last communication time. And then we don't know anything about what has happened to the client's risk preferences till the last communication time. And this sequence is, I mean, as I mentioned in this presentation and also in the paper, we assume that the sequence is deterministic. So we communicate, for example, every 3 or every 5, every 10 days. And the parameter k determines, the parameter phi determines exactly what's the time between two consecutive interactions. If it's if you communicate every 2 days, then phi will be equal to 2. If we communicate every 5 days, 5 would be equal to 5, etc. So for example, the sequence could be T1 is equal to 5, then 10, then 15. It means that you only communicate every 5 days. So what happens when there is a communication? When there is a communication, the client is communicating the risk aversion coefficient to the robo-advisor. So whatever is the true intrinsic risk, I mean, so not intrinsic, whatever is the risk aversion coefficient that that he perceives at that time, or she perceives at the time, and this risk aversion coefficient will be impacted by the behavioral bias. But that's what the robo-advisor gets, the contaminated risk aversion coefficient from the client. And based on this information, the robo-advisor is constructing its own filtration, which of course depends on the market outcomes, like the sequence of returns and the sequence of regimes, because both the investor and the robo-advisor both observe perfectly the market outcomes and the economic regimes. And then robo-advisor is also observing all the time at which there has been a communication. This tau, remember, keeps track of the times where there has been a communication. And this gamma contains all the risk preferences that have been communicated by the client to the robo-advisor when there was a communication. So in a way, the robo-advisor filtration is a subset of the client's filtration, because this information tau and gamma is only available at the time where there is a communication, whereas the client knows what is his intrinsic preference at all times. And then based on this information, the robo-advisor will construct his somewhat risk preference estimate of the client risk aversion. So it's a function of the n, it's a function of all this information that has been communicated. That's what that's the difference between the client and the robo-advisor filtration. So now the robo-advisor can solve the mean variance optimization problem. So what it does, this is a sequence of mean variance optimization problems, because it's solved at any time n. It's not only solved today for a terminal maturity. I mean, the maturity is fixed, so that's the terminal horizon. That's when the client wants to go to the robo-advisor and see what wealth he has obtained. But at any point in time, there will be a different optimization problem triggered from the fact that this parameter gamma might have changed. This gamma r, which is the robo-advisor's view of the client risk preference, changes dynamically over time. Okay, so that's really where the adaptiveness of this problem comes into play. It's adapting to whatever information has been communicated by the client, and therefore it's adapting to the robo-advisor's views of the client risk aversion. So the first term is the expected return, and the second term is the variance of the returns. The return is defined as the difference between the terminal utility at time capital T minus today's the terminal wealth at time capital T minus the wealth today divided by the wealth today. So the probability measure that is being used to define this expectation and variance is the conditional probability conditioned on the level of wealth and on all the information that is available to the robo-advisor at time n, which is collected in this random variable capital Dn. And one can solve this optimal investment problem. In the end, it boils down to solving a time inconsistent optimization problem, where the time inconsistent comes from the fact that you cannot really use directly the dynamic programming equation, because the risk preference is changing over time. And essentially, what you can do is you can expand the system of HAB equations to account for the fact that there is this time inconsistency. So time inconsistency here really means that if you design a policy today, the policy specify based on the wealth and based on the value of the stock, how much you should invest. This is not the same throughout the horizon. So if you decide today on the optimal policy function, and then you look at time n+2, what should be the optimal policy function, this policy function might be different from the policy function that you decide today. So that's why the problem is defined to be time inconsistent. But this is a technical implication that one can deal with, and in this case, we can solve explicitly for the optimal investment strategy, which, as you can see, contains two terms. The first term is the term that you also see in the classical one-period mean variance Markowitz problem, 1 over the risk preference times the expected value of the return process divided by the variance. And the second term instead is the adjustment that you have to do in order to account for the fact that the risk preference is changing over time. And this depends on the covariance between the return from today to tomorrow and also the return that you get, the return and also the return that you get from tomorrow to capital T and the same quantity adjusted for the excess market return. So I want to comment out a little bit on what this means, and I have another slide which shows exactly what happens. But here I just want to point out that there is the current risk trade-off parameter gamma n r, which matters, but there is also the dynamics or the future values, this risk return trade-off parameters, which matter, and these are incorporated into this term, this covariance term, because this covariance term, which is the return that you get from time n+1 until capital T, depends on what sequence of risk preferences you had realized from tomorrow till the end. Okay, and this is essentially zooming a little bit more on the structure of this optimal strategy. Let's forget about the first term, which is what you get from the standard single period Markowitz problem. But now if we look at the second term, here we see that this is an intertemporal hedging component. So this is essentially incorporate out market returns and economic conditions are impacting the risk aversion of the client. So that's the idea. Suppose that what would you do at time n based on what is going to happen in the future? So the idea is the following. Suppose that the market return go up, so the return from time n to time n+1 goes up, then typically what happens is that the client becomes less risk averse. So the robo-advisor will estimate a lower risk aversion from the client, and as a result, they will invest more in the risky asset. But if they invest more in the risky asset, this means that the return from time n+1 to capital T is going to go up, which means that this covariance here should be positive, right? The covariance between future returns and future returns adjusted by the current market return will be positive, because like every time Z tilde goes up, R also goes up. So that means that today, the robo-advisor is reducing somewhat the amount that invests in the risky asset in anticipation of the fact that the client will become more risk averse, less risk averse in the future, and therefore he will invest more in the risky asset. So the idea is that if you know that in the future the client is becoming less risk averse, then you want to reduce your investment in the risky asset today, because it will be increased or adjusted for later on. So in a way, it's like as if there is a negative hedging demand for client whose risk aversion is negatively correlated to market return. So this is typically what happens for most clients, that as the market return goes up, the risk aversion goes down. Okay, so now I want to specify a risk preference model just to illustrate some of the results. And here, there are two parameters we need to specify. One is the risk aversion of the client, which can change because, of course, passage of time. So as a client ages, becomes more risk averse. There might be shock demographics, but importantly, there could be also event in the market or economic condition which impact the client risk preference. And the idea is that both risk aversion and the Sharpe ratio are counter-cyclical. I think there is a lot of, there is a lot of work in economics which basically has argued that the risk aversion and the market Sharpe ratio are higher at business cycle truth than at peaks. And there has been also some work which has shown that when the economic state, when the economy goes down, the client risk aversion typically goes up because the client becomes worried about the state of the economy. But these are also the times where the Sharpe ratio, the market Sharpe ratio goes up. And as a result, it becomes cheaper to buy a stock because there is more return that you are getting for the same unit of risk. So in a way, the client is using the market exposure because the client becomes more risk averse, and therefore he wants to invest less in the stock. But these are exactly the times where it should be good. It would be good to do that because Sharpe ratio that you would get is higher. And this is exactly back to the question of Lisa, the important use of robo-advising, that you want to prevent the client from leaving its investment exactly at the times where he would be able to earn more from the larger market Sharpe ratio. Now, the communication that happens between the robo-advisor and the client works in this following way. So the robo-advisor is the client is communicating a preference, which is the product of his intrinsic risk preference, gamma C, times this quantity gamma n Z, which reflects the bias coming from stock market performance. So in a way, this is just a modeling choice. We are modeling it as the negative exponential of this moving average. In a way, if the returns are above their expected value, so this mu k plus 1 is the unconditional expected return. So if the market returns are above their expectation, then it means that the client basically sees that the market is outperforming his expectations, and therefore he tends to reduce his risk aversion. And this is modeled by the fact that gamma n c will be like a negative exponential. So that means that gamma n will be smaller than gamma n c. And instead, if the opposite happens, if the market is underperforming the expectation of the clients, then this quantity here in parentheses will be negative. So negative is a positive term, which means that risk aversion communicated to the robo-advisor tends to be larger than what the intrinsic risk preference of the client is. So this is essentially the bias which is being added when there is a communication. And this is the reason why, even though you are communicating at all times, you are not really getting as a robo-advisor the correct risk preference of the client. So the robo-advisor will try to infer what the client risk aversion is by taking an conditional expectation of what the client risk preference is, given the information that is available. And it will basically adjust this for the passage of times, realize market returns, etc. So now let's go to the way we measure portfolio personalization. So in a way, personalized portfolio, what we mean here is really that the strategy that you're offering to the client is consistent with this true preference. Now, there is a one-to-one correspondence between the risk preference parameter and the optimal strategy, especially in a Markowitz model. If you give me exactly what is the risk preference parameter, the mean variance trade-off coefficient, I will be able to tell you exactly what is the composition of your wealth in terms of risky and risk-free asset, right? So instead of using the optimal strategy here, I'm using directly the risk preference parameters because there is this one-to-one correspondence. And this personalization will depend on two parameters: how often robo-advisor and client communicate, which is the parameter phi, and also what is the strength of the bias in the communication. And these two parameters will affect how close the risk preference parameter of the investor is to what the robo-advisor is estimating. And what in this paper we do is show that there is a very important trade-off between the rate at which you get information and how accurate this information is. In a way, there exists, you would be tempted to think, okay, if phi is very small, so if there is more frequency of interaction, then this quantity will be lower. But this is not the case. In fact, for a given beta, for a given level of bias, there exists an optimal interaction frequency that minimizes this measure. And the more bias there is, so the larger is beta, remember, beta captures how responsive the investor is to bias, the less frequently you want to interact. So phi, which is the time between two consecutive interactions, is increasing in beta, where beta is the strength of the behavioral bias. And in this figure that we have plotted using the optimal strategy, you see exactly this effect more prominently. For example, if there is no behavioral bias, then you really want to learn as much information as possible from the client because he's not communicating any bias. So it's optimally to interact at all times. Now, if there is more and more bias, then you want to interact less and less frequently because the client is contaminating this information with bias. Okay, so that means that if you get information too often, then it also means that you are investing based on biased information. So that's why you want to reduce the frequency of interactions. And here I have not solved the problem of trying to remove behavioral bias from the client communication simply because I'm thinking a robo-advisor who is catering to the client wishes. So if the client wants really this investment to be done according to his level of bias, the robo-advisor is adapting to that. I think the question that Lisa asked about like disentangling this effect and trying to remove the behavioral bias from what the client is communicating, that would be also a very interesting extension or like modification of this framework where you try to really, as a robo-advisor, de-bias the information that the client has revealed. So now I want to discuss a second approach to robo-advising, which is the so-called goal-based investment. And this is what like Betterment, for example, is doing. I want to start with a quote from Merton. I mean, there was, which I very much agree. So there has been a panel discussion, I think in 2019, right before the COVID started. And there was a panel between Merton, Andrew Lowe, Stephen Ross, so all people who definitely had a big impact in the field of finance. or financial engineering. And I mean, Merton basically highlighted the importance of goal-based investing. So he said that there is a lot of emphasis on Sharpe ratio. So every firm is basically showing to show that they are better than others. They show that they're able to attain a larger Sharpe ratio. But this point is that we should focus more, especially if we put the emphasis on the client, really on managing the wealth so that we can meet goals. And in a way, to follow the so-called liability-driven goal, which means that you want to invest in a way that when that comes down to the time where the client wants to take his money off, and the client had an expectation of having enough money to buy a house, enough money to pay for a vacation, enough money for retirement, then the robo-advisor is able to deliver this amount of money to the client. In a way, you can do that even without achieving a large Sharpe ratio. So it doesn't matter whether your Sharpe ratio is exceeding those of your competitors, you can still outperform them if you don't lose focus on the goal, if you focus really on what the client wants, regardless of how large is the Sharpe ratio. And his point is that we should be driven to the idea of greater service, knowing the client better, understand what the client wants, rather than always trying to optimize on the Sharpe ratio. And this, yeah.
If you're going to optimize Sharpe ratio, then as you discussed, you need to know what the client's risk preferences are.
Yeah.
So to do this, you need to know what the goals are. And
yeah.
One of the concerns is that people tend to dramatically underestimate the amount of money they need to retire. So,
yeah.
If they have $60,000 in their 401k plan, they think they're rich, when of course that's not remotely enough to make a meaningful contribution over, let's say, a 20-year retirement. And I'm just wondering, are you going to talk about ways of determining not what the client says the goal is, but what the client's goal ought to be, based on, well, I'm not quite sure based on what?
Yeah, no, it's a great question. I agree that the client tend to underestimate or overestimate the goal amount. For example, in the case of retirement, they tend to underestimate what should be their goal amount when they retire. And they also may tend to underestimate how important it is to achieve some goals over others, which essentially is the same level of difficulty as estimating what is their true preference. So if you ask the client, okay, what is his true preference? He doesn't know. If you ask the client, how much wealth do you want to have in your account when you retire, then he will also be unsure. So his estimate would be definitely different from what he really needs. In this second part of the presentation, I'm going to basically set up a model where the client specifies goal amounts and its priority for those goals, but I'm not going to take into consideration that he might have misestimated those goal amounts. With that said, I think your question is very relevant and very important. And in fact, I think what we want to do initially is indeed to also take into account that over time, you might realize that you want more, you want less, and how do you adapt your strategy? I view this like a second, as an important extension of what we are doing here. So this was just trying to set up a framework where you can do this goal-based investing. But I completely agree that assuming that the goal amounts are known today and they will never change is far from what you would see in reality.
Thanks.
Yeah. Good question. So here, the point is that most of the academic research, when you think about risk, you always think about volatility, right? If you ask anybody, maybe not those of us who are very familiar with finance or who have worked in financial engineering, but if you ask anybody, even like professionals who are not familiar with finance, okay, what does it mean risk? It means volatility. You are worried about variation, or in the returns, you are worried about whatever is not predicted today about what the return will be tomorrow. Right, so volatility is basically measure risk, but volatility is a symmetric measure of risk, and it's just one of the many different ways you can measure risk. But if you think about investors also who deposit their money to the bank, typically for them risk is what's the probability that when I go to the robo-advisor and I want my money because I need to pay for the school, for example, of a kid, then you will not have enough to attain these goals, right? This is a risk. The risk that the robo-advisor may not have enough wealth available at exactly the time where this is needed by the client. And this is the notion of risk that I'm going to discuss now. So it's like goal risk in a way, the risk that your goal may not be attained. And this is very different from volatility, because if you have an underfunded portfolio, which means that the portfolio of the robo-advisor is not really matching what should be the goal amount in a month or so, then what the robo-advisor would have to do, he will have to take more risk, right? If you are underfunded, it means that you have to increase the funding level so that you can meet the goal. Then you have to take more risk because you have only 1 month left. And if you don't take extra risk, you will not be able to attain this goal. So that means that in some situations, increasing the standard deviation of your portfolio is a good thing. It's not a bad thing, right? If you think about risk aversion, utility maximization, typically you always every time you increase risk, this is bad because it decreases your utility. But in this case, it might be good to increase the risk. And there are different tiers of investment goals. I think if we look at the pyramid here, you have like some goals are basically related to covering the needs, the essential. So you really need to pay for if you get a mortgage, then you have to pay the mortgage. You need to have enough money with very, very high probability. Otherwise, you will basically default on your house payment. Then there are some wants, things that can improve your lifestyle, but they are not really essentials. Then there are aspirational goals. So wishes, you wish you could basically get a vacation, which is very expensive. But of course, even if this doesn't happen, it's not the end of the world. And then of course, there are legacies, like you want to leave some money out to your to the future generations, etc. Now, there are like some estimates about what investors think about success probability of some goals. For example, if the investor wants to realize dreams and they want to avoid concerns, that means that they want to realize dream with some probability between 50% and 60%, and they want to avoid concerns, again, with the same probability. If we think about wishes and worries, so like not really, dreams are really things that, okay, it will be great, but if it doesn't happen, it's okay. Wishes means, okay, it's more, even if it doesn't happen, it's not the end of the world, but still I would like it to happen. And here we see that the success probability between realizing wishes and avoiding worries between 65% and 75%. Then there are wants and fears, really something that you really want to get because it's important. And you want to avoid fear. So this happens with probability between 80% and 85%. And then there are needs and nightmares. This means that really you need to pay, for example, in the case you're paying for a mortgage, you really need to have this amount of money in 5 years, because otherwise you will default in your house. So you want this to be very high priority. Those goals should have a priority or a probability of being successful between 90% and 95%. Otherwise, like you will really, this would be very catastrophic if it doesn't happen.
Sorry, Agostino, was that a survey?
Yeah, this was a survey that had been done in this paper by Brunner.
Do you know who got surveyed?
Not completely sure, Lisa. I would have to look at the paper.
Yeah, I'd like to do it too. I mean, it clearly isn't the homeless population.
Yeah, I mean, this survey also wanted to take into account that they change very frequently. So if you redo the same survey today, I don't know if the estimates will be the same. But
yeah, I'll take a look. That's really interesting. Thanks.
Yeah. And this means that here I know that there has been another survey done by Franklin Templeton, which is like one of the firm that is like asset manager firms. And what they did is they asked the investors to rank their top 3 goals, and then they looked at their responses. So for example, in the case of retirement, it means that 46% of the investors they queried, they find retirement as one of their top 3 goals. 43% of the investors that they queried, they find planning a vacation as one of their top 3 goals, etc. So then emergency, purchase a new home, and so on. And this was also a study that the survey that was done a few years ago. So I think as time passes, typically retirement is always the most important, but like for the other goals, there might be differences in terms of what are the top 3 goals. So now what we are doing here is deciding how we can prioritize between multiple goals. The basic question is, should an investor forgo an immediate goal because this will increase his chances to attain future goals? For example, you might say, okay, on this immediate goal, which was the goal of paying for a vacation, I might fail because I wanted $10,000, but in the end I only have 5,000. Then it's not really worth to increase the risk drastically to get to 10,000. So let's forgo this goal. Maybe I will not go for, I will not take the vacation, but I can use this wealth to increase the chances of attaining future goals. Because, for example, 15 years from now, there might be a more important goal, for example, pay for children's education, which I want to achieve with higher probability. So the relative importance of the goals is important. And the fact that even though you may not achieve in full a specific goal, for example, if the goal was to buy a car, you may still partially fulfill your goals because you might end up buying a cheaper car. And what we want to do is we want to optimize all goals in a single portfolio. So that means that we can offset between underfunded and overfunded goals. If a goal is overfunded, it means that the current wealth allocated to that goal is above what was specified by the client. I can take some of this wealth off from this goal and reinvest it into another goal, which is currently underfunded, right? So this is capturing this. And how do we think about this mechanism of basically making sure that all goals are sufficiently well funded, especially depending on the priorities that you give for those goals? Is essentially constructing an asset and liability management framework. So that's like really used by many institutional investors. The idea is to manage assets to meet future liabilities. So I manage so that when the time comes, I will be able to meet the liability. And in general, like every goal has a target amount and the target date at which you want to meet that goal. For example, I want to buy a house which costs $500,000 in 5 years. So the deadline of this goal is 5 years from now. The target amount is $500,000. This is a ongoing work that we are doing with Yushang Zhang from the University of Toronto. We are taking multiple goals for a single account. We are assuming that goals are fungible, so you could take wealth out of a goal and use it to finance another goal. And the basic trade-off here is between consuming immediately to satisfy the current goal versus savings to meet future goals. The client is providing the following input. There is an initial amount of wealth that he has, a contribution rate. So the way to think about this contribution rate is the fraction of each paycheck that is deposited to the account of the robo-advisor. So how much, let's say if I is 50%, it means that he wants to take 50% of his rate, of his salary, and depositing it to the robo-advisor account. Typically, this is like around 10%, but it's not more than that. And then the client is specifying also the goals. Specifying the goals means specifying the goal amount. Suppose that there are M goals, M different goals. For each goal, you specify what's the amount of the goal. That's the dollar value of this goal. How much do you want to satisfy this goal? What's the deadline of this goal? Like, when do you need this amount? And what's the relative priority of this goal? When I say relative, it means what's the probability that you want this goal to be achieved relative to others. For example, if the first goal has a very high probability relative to the others, then this alpha could be very large. For example, if you specify alpha 1 to be 90% and alpha 2 to be 10%, it means that the first goal has a much higher priority than the first goal. It's 90% priority, whereas the second goal is only 10% priority. And of course, the priority is important because it meets, it specifies what's the strategy that the robo-advisor should follow. Because if, for example, you have a high priority goal due in 1 month with a very large goal amount, and then you have a very low priority goal with a small amount due 5 years from now, you want to take the risk, you want to increase the risk as much as possible because this goal has a very high priority, right? And you need a large amount to satisfy it. So this is really driving the investment strategy. These parameters are critical. And back to the question of Bob, here I'm not really assuming that this goal amount might be different from what the client wants. So I'm saying that the client specified this goal and then he will be happy if this goal is satisfied. So it's not changing his mind over time about what should be the goal amount. So now if we want to solve the model, we have essentially to specify the wealth of the client. This is, we're assuming a log asset dynamics driven by an n-dimensional Brownian motion. So the dynamics of the asset are geometric Brownian motions, which are correlated with each other. Pi is the fraction of wealth that I want to invest in each asset. At the time where the goal is due, the amount GK times theta K is withdrawn from the client. So what is theta K here is the funding ratio. So the way to define this funding ratio is the ratio between the wealth that you are allocated to the goal K divided by the goal amount. So that means that if you are really funding this goal in full, then it means that you are having that theta K is equal to 1. That means that the wealth amount that you are allocating to this goal is exactly equal to the goal amount. And in this case, the goal is fully funded. And when the time comes, you take out from your current wealth the one that you have given to the client because you have satisfied this goal. But even though this theta K is smaller than 1, which means that the goal is only partially funded because the numerator, which is the current wealth allocated to the goal, is lower than the entire goal amount, then you'll still be able to give to the client something. It's not really all what he wanted, but it might be 50% of what he had requested. And then you will take this wealth out of the equation, right? Because you cannot use it anymore to invest for future liabilities. What the robo-advisor will do here is he will maximize the expected fundedness of the goal weighted by their priority. So this theta K is, remember, the fraction of wealth allocated to the goal divided by the goal amount. And alpha K is the parameter which is measuring how important is this goal. So you want to maximize the weighted fundiness, the expected weighted fundiness of the goals. And we assume also that there is no borrowing constraint because robo-advisors do not go short. They just invest the client's money. So there is no way of shorting an asset. And in general, this framework could be incorporated. In fact, I think in the paper, we are also accounting for constraints at the strategy level or at the portfolio level. For example, you might request that the fraction of wealth that you are allocated to each individual asset is not too large. You don't want to have excessive concentration in one specific asset. This is one of the constraints that Betterment is imposing on its strategy. They don't want to invest an excessive amount just on a specific risky asset. Now we end up with a stochastic control problem that we have to solve backward in time. So again, at time t, we want to find the strategy pi and the fundedness ratio theta, which maximize the expected weighted fundiness of the goals. And I want to define also the safety level to be the smallest wealth level, which guarantees that all remaining goals can be achieved with probability 1. Fully funded means that you will have exactly the same amount as the goal, the same wealth amount as the goal amount with probability equal to 1. So this means that you are safe, meaning if you achieve this safety level, that means that the optimal strategy could just be deposit everything in the bank account because you will be able to meet all the remaining goals with probability 1. And when we want to solve for when we want to solve for the optimal strategy pi, the optimal fundedness ratio theta, and the value function of this control problem, we can solve it recursively by iterating between the value function and the safety level. So let me show what happens. Like you go backwards. So the final goal maturity at time tm, what is the value function? Is just the maximum between the priority of the last goal and the fundiness of the last goal. And what do you do? It's very intuitive to understand what happens. Like at time m, there is nothing else afterwards. So what you do is you look at the minimum between the wealth that you have and the goal amount. If your wealth is above the goal amount, then you will fund the goal amount in full, right? This minimum is equal to 1. If your wealth is lower than the goal amount, then your fundiness ratio will be exactly the all wealth divided by the goal amount, because you deposit or you allocate all this wealth to your current goal because there is nothing else coming afterwards. If you are between different goal maturities, then you have to solve this static optimization problem, right? This is exactly at a goal maturity. So you want to decide how much to allocate to the current goal, which is alpha k theta k, plus how much to allocate to the future goals. So if you do not, if theta k is equal to 0, you don't detract anything from your current wealth, so you will be able to achieve a larger value for your remaining goals. If instead theta k is equal to 1, you mean you fully satisfy the current goal, then you will detract the goal amount from your current wealth, and maybe your future utility will be lower, right? So this is exactly capturing this trade-off between allocating a lot today versus saving for future. And this is this fundedness ratio theta, they will be obtained by solving static optimization problem at the goal maturities. And then you will have to look at what happens between two consecutive goals. So in a way, so when you solve for this optimal strategy, you have to solve static optimization problem at the goal maturities and dynamic optimization problem between goal maturities. Because between two goal maturities, what you need to do is to invest in the risky asset in order to maximize the wealth or the utility that you get when the goal comes due. And the strategy that you use to solve for when you are between two goal maturity is exactly obtained by solving an Hamilton-Jacobi-Bellman equation, which has some boundary and terminal condition coming from the fact that you want to, first of all, achieve as a terminal condition the value at the goal deadline, and as boundary condition, you will have that you have to take into account that if you are at the safety level, you will be able to satisfy your future goals. And you also want to take into account that you will not go bankrupt. So if you have zero wealth, you will not be able to invest anything. So this is basically specifying the Hamilton-Jacobi equation, which is the optimal strategy between one goal deadline and the next goal deadline. It's not an easy Hamilton-Jacobi-Bellman equation to solve. In fact, you can only solve, you cannot find a smooth solution. So that means that C12 solution, a differentiable, continuously differentiable solution. But what you can do is to show that there exists a solution in the viscosity sense, which means it's continuous, but it's not necessarily differentiable at all points, especially at the points where the goal deadline happens. And then we looked at a numerical setting. We looked at two different profiles of client, the so-called generation Z, who are the client born between 1997 and 2012, and the millennials, who are the client born between 1981 and 1994, like according to the classification. The reason why we look at these different type of clients, because they have different priorities. For example, for the generation Z, their goals are more short-term: buy car, finance a vacation, pay off the debt because they just finished college and they want to repay their debt. For millennials, they are more like thinking about retirement and like saving for life milestones and future goals. This is according to different surveys that we have seen. These are the goals which popped up as the highest priority goals. And I mean, this is just a study case that we did. For the generation Z, we assumed that all goals have equal priority. We had like buy a car, finance a vacation, pay off debt. And these are just numbers we came up with. It's $30,000 for a car, like $10,000 for a vacation, $250,000 for the debt. And these are the different goal deadlines: 5 months, 2 years, 5 years. For the millennials, buying a house, which means I view this as the mortgage that you have, the initial payment that you have to make when you decide to buy a house, which say $250,000. Perhaps in California or Palo Alto it might be more, but let's say on average, let's say that this, I mean, New York, it's also probably more, but if we take an average across the United States, maybe 250,000 might be a reasonable amount. And for retirement, let's say you want to take $10,000, you want to set aside $80,000, which is, let's say about 50% of your salary or something like that, for 20 years, which is about $1,600,000 after you retire. And the priority is 73% for the first goal and 75% of the second goal. Like, these are numbers that I've estimated based on some data. And and then if we plot the value function and the strategy, the only point I want to make is that there are points where the value function is not smooth. It's continuous, but it's non-differentiable. And this happens exactly at the goal deadlines. So at the goal deadlines, the function is not differentiable because the strategy switches because you are taking wealth away from your account in order to meet the current goals, and this will be impacting the value function of the strategy. And if you look at the optimal investment strategy, here what you see really is that there is this fact that if you are above the goal amount, then you may want to stop investing in the risky asset because you want to be sure that you meet the current goals if this goal has a high priority. But if you are below the current goal amount, so this X variable is very important, then what happens is that you may want to increase the amount that you invest in the risky asset because you want to meet this goal with high probability. So you see really that the strategy changed from maybe investing nothing in the risky asset to investing a lot in the risky asset, as you see, for example, from a section of this curve. And this happens precisely because when your wealth is too low, then you have no choice than try to invest as much as possible in the risky asset in order to profit of volatility and try to make the goal amount that you needed for the deadline. We have a similar, for the millennials is a little bit smoother, partly it's because the goals are more longer term, so that you will have more time to meet them. You don't have to take excessive risk today, but you still see that the optimal strategy has these effects that it might change from investing all in the risky asset to invest nothing in the risky asset, depending on whether or not you are on track with the current goal or you are underfunded. Okay, so I think I want to stop here because it's running out of time, but we were also thinking about what happens if you are not on track on a current goal. You could always have a dialogue with the investor and say, okay, we're assuming that we wanted to meet a specific funding level, but now we see that you are underfunded. So what do you want to do? Do you want to increase your contribution rate, or do you want to reduce your goal amount so that we can meet your future goals with higher probability? So this could be basically a way to renegotiate with the client about the goal amounts. For example, back to the question of Bob, if you incorporate this extension into the model, then at the time where you see that you're underfunded, the client can say, okay, actually, I want to increase my goal amount for retirement because, yeah, I think I'm now overfunded, right, relative to the initial target. So I can afford to specify a larger amount when I retire. And then the robo-advisor will adapt his strategy in order to meet this new goal amount that the client has specified. And I want to stop here. I realize that I took almost all of the time, but I hope there will be other questions, and I'm also happy to stay more.
Yeah.
Is there any question? Yeah.
That was really fascinating, Agostino. I especially love the personalization aspect that runs through all of your talk. This is super deep research and interest of mine. But I would like to open up to the audience to ask any further questions.
Yeah, I have a question.
Yeah.
Okay, so this last part where you were talking about basically if you're underfunded for your goal, that you would invest more into the risky asset.
Yeah.
That could be regarded as poor investment advice, because at a time when you really can't afford to lose money, you're increasing the likelihood that you will lose money, and that the whole idea of sort of shooting for the moon when you really can't afford to, which is, as far as I can see, is it's a result of focusing on the probability of meeting a goal rather than on a more, let's say, a more complete utility function that would take into account, that you just really can't afford the losses that strategy might lead you to.
Yeah. No, that's a great point, and I agree with you. I think in this current framework, that's what you would obtain, that you will take excessive risk because you're not on track on that goal, you're underfunded, and therefore you want to overcome. You want to make sure that you are able to meet the goal. Now, in order to prevent this from happening, you would have to specify also some shortfall constraints. For example, you don't want to go short, you don't want your wealth level to drop by more than a specific amount. This will limit, of course, the amount of risk that you would take, and it will avoid that you end up with a probability, you end up with a large expected shortfall. So this could be incorporated by specifying these constraints into the problem.
Couldn't it also be addressed with a utility function?
Right. I mean, you could introduce an utility function, but then I think you would defeat a little bit the whole purpose of bypassing the utility function, right? When you specify, when you use a goal-based approach, you really want to replace the utility with goals and priorities. So this, instead of utility, you specify what's the probability that I want to achieve that goal and what is the amount of that goal. Now, if you specify an utility function, then the client will have to specify too much information and he might not know its utility. But that's the idea of using goals. Now that clients are better off at specifying what's the probability that they need, for example, to satisfy a goal, which is buying a house or paying for a vacation, rather than specifying a measure of how averse they are to risk, because they always feel that they don't know much about their own risk preferences. But yeah, if you integrate these two approaches in the way you said, then you will attain also the goal of reducing excessive exposure to a risky asset, precisely because you specify a large risk preference, a risk aversion parameter.
Any further questions? Going once, twice. Okay, well, let's thank the speaker, Agostino. That was wonderful. I will be in touch with many questions. So many threads for me. I didn't want to take up too much of everyone's time with them, but I've noted them down. So thank you for a fascinating and very topical talk. Next week is Cal vacation, so we will not meet. The following week, Sanjeev Das, Santa Clara, is going to talk to us about multimodal machine learning at scale. So I hope to see many of you then, and everyone have a really great day. Thank you.
Well, thank you again, Lisa, for the nice, wonderful experience, and thanks everybody for attending. Yeah, any question, I'm always happy to answer and engage in conversations. So feel free to reach out to me.
Thanks so much. Bye now.
Bye everybody. Bye, Lisa.